Good afternoon, everyone, and welcome to our market update and review. And thank you for joining us. I'm Mark Allara, and I'm joined here by Kenneth Beanland, who's an investment advisor in our Morgan's Mount Gravatt office, which we have an affiliation with our Vincents team. Today, I'm just going to do a quick run through on the fixed interest market. Just to give a bit of an update on what's happening in that space, what we're seeing happen, and what we expect to take place. There's a bit of activity coming up over the next few things. The next few months, we've got maturities in that space, and what will happen with that cash. And Kenneth's going to discuss the equity market update, go through the recent reporting season that we've gone that's just been passed. And he's going to look at some investment themes which might have a few stock picks, some currencies and commodities expectations. Okay, so just a quick summary of the various fixed interest sectors. I think, look, in cash, I mean, there's a lot of commentary around this space and not a lot of surprise in this space. I mean, particularly Morgan's house view is that there's an expectations for rates to further reduce in the second half of this year. There's even talk about the prediction that it might be a Melbourne Cup, so I'm not sure who's betting on that, but that's the prediction. Additionally, particularly I know our chief economist in Morgan's, Michael Knox, he's got a further reduction in the first half of 2017. The term deposit space, as a result of the reducing cash rates, we're seeing reduction in those as well. And the yield curve is pretty flat in that market. So in other words, what you're going for a 30 and 90 day out to a 180 day or a 1 year, you're not really seeing what should be an uptick, a material uptick in return for duration. We're not seeing that. You're seeing a marginal uptick for duration. So it means that the yield curve is flat to what it normally you'd expect in a normalised position. And we're seeing that the premium that's previously been paid to investors over a 1 year term deposit with a 1 year swap rate, it's continued to erode. It's come down about 0.5%, which is the major banks 1 year term deposits around that 2.7%, and the 1 year swaps about the 1.7 or just a tick over that. So we've seen that margin close to 1% now. The government bonds, I'll talk a little bit further about that. It continues to be volatile. We expect this to be an ongoing trend in the next financial year, or the current financial year, up to 30 June at least this stage. We're still keeping underweight, particularly the long dated, just because of concerns about capital risk with the movement if bond yields expand, and long dated ones particularly. And given that the alternatives in our market at the moment, with the government guarantee up to 250,000, the yields in those term deposits can provide a comparable, or if not some stages, a better return to that. It doesn't mean bonds don't have a role. It's just from a retail investor perspective that might be more appropriate. In the listed fixed interest space, we've seen over the last few months, we did this presentation 6 months ago, towards the end of April. At that point in time, we said the hybrid market looked cheap, and that we expect that to re-rate up, and we have seen that over the last 6 months. So we've seen a rise in capital prices, and where there are opportunities to take advantage of weakness, we're still recommending clients build positions in this market, particularly in what we expect to be a prolonged low interest rate environment. The bond yields, I guess to look at that, we look at the US first. Leading up to the US Federal Reserve meeting, we saw bonds heavily sold off and yields expand, or the yields rise, and with the expectation that the US would also rise interest rates. As of last week, after that meeting, we saw that didn't happen, and then, but whilst that didn't happen, our in-house view is that there's a high probability that potentially in December that that still may be on the cards, particularly as the US has strong employment growth, and that they'll want to control inflation. Since that meeting, we've seen a bit of a contraction in those bond yields, but again, there's the expectation that it's just a short-term movement, and that longer term, as interest rates rise or potentially rise in the US, we'll see those yields expand back out, and the capital prices come off. In Australia, quite a different story. We'll look at the Reserve Bank of Australia. They're looking to cut rates, as mentioned earlier. One potentially by the end of the calendar year, and a second one in the first half of next year. So as a result, our shorter dated bonds, the yields remain low, and the price is high on those, and we probably expect that to continue. The long dated 10-year bonds, they correlate or tend to correlate heavily with the US, and therefore retail investors, should probably be better served considering term deposits, as it remains probably the best risk-adjusted return in that space, albeit very low. As we can see that with lower cash rates, we've got the 0.5% or 50 basis points since our last, when we did our presentation in April, which is pretty close to, I think we said 2, maybe 3 cuts back then, or we've seen 2 come through. As a result of that, we've also seen, all the swap rates, fall down consistently across there, all the way out to the 10-year swap rate. So the result of that, if from that graph there, we can look at the dark perforated line where it was a year ago, as opposed to the full dark blue line where it is at the moment. We see that from cash, 90-day, 80-day bank bill rates, all the way out to the the 10-year swap rate fall. The impact of that, is that we've seen yield across our market having fallen, and consequently, the overall yield on return on particular securities has fallen as well. Particularly, when we're looking a bit further into the hybrid market, where they're paying or the floating rate securities are paying a fixed margin above either a 90-day or a 180-day bank bill swap rate. So there's two aspects there. One is that there is what happens with the margin, and then two, we're seeing this is the impact of a fall in interest rate. That's just a different view of that. Looking over the last 5 years, nothing really surprising in that, particularly in the last 12 months, as we can see the cash go from 2% down to 1.5%, and seeing that all the bank bill swap rates following suit there. I've got the volatility index here. Look, we'll probably address that in Kenneth a bit more, particularly in the equity market, where the historical trend's been, and whether about we should be complacent. There are some flow-on effects of that, particularly in the bank-rated securities, whether that the impact it might have on the hybrid market. So looking at that hybrid market, you're looking at the tier 1. As we said earlier, that we thought it was cheap back then in April, and we've seen a reverse in the capital prices of those, and particularly over the last few months, as well as the debt securities, they've bounced back as well. The debt securities tend to have a lower level of volatility, just because of their senior ranking, particularly in volatile times. So in that space, we've seen a few raisings take place, and we've seen, we're looking to see what we believe a few more take place over the coming period. In this ultra-low cash rate environment, they're very well supported at the moment. So, the investor appetite, has been high and remains high. and particularly we expect that to continue if we have further rate cuts going forward over the next 12 months. Some of the recent ones that's come through is the Commonwealth Bank Pearls 8, the NAB capital notes, the Westpac capital notes. All of those were very well supported, and saw their initial offerings or size of the offer upscaled. So they took more monies and obviously met with strong investor support and buy-in there. But more importantly, when the level of that strength was shown further when they came to the market, and they saw premiums upon listing, so above their face values there. So and you can see some of those premiums there. Face value of $100, and upon listing the CBA, up 2%. It's continued to rise now to 4.5%, and we've seen the NAB up 1.2 and the Westpac up 2% as well. So quite well supported. So I guess where does that leave us in our market at the moment? What opportunities do we expect to come up? There's quite a few call dates over the next 12 months coming. Particularly there's one we're doing at the moment, or associated with more associated with the raising, which is lists in a couple of days. The ANZ PAs. On that there, we've sort of seen 900 million of those reinvested, and the others will be redeemed in December this year. They're going to commence trading on the 28th. We saw the margin go from about, I think it was 3.1, Kenneth, out to 4.7 this year. So we're seeing an expansion in that there, and very well supported as well. Other spaces in there, we look at the IAG PCs there, and there's the ANZ PCs. Expecting them to roll into new securities when they mature at improved yields. The yields for the new IAG note to be in the vicinity of 5% or plus the 180-day bank bill rate. Current ones are 4% above a 180-day bank bill rate. And the new ANZ note, we expect that to be similar to the one that's just been issued, which is the ANZ PAs rolling into the ANZ PGs. If you look down that list there, there's the or the Heritage, which is a HBSHB. They're not been told whether the senior debt issue for that will be rolled, and whether there'll be a new issue. But it'll depend on the alternative funding options, near those call dates. And you'll see similar stuff to the ANZs, the Colonial and the NABs, which is the ANZ HAs, CNG HAs, and NAB HBs. That's the ANZ, which I've sort of just mentioned. We've seen that, even at these levels, when it lists on the 28th September, we still think it'll be well supported, and particularly in this environment, we think they're offering attractive margins above a bank bill rate, so the gross yields are still looking quite attractive on that. So around that 6% mark gross, it will initial yield at least anyway. Woolworths is it's also announced its intention to redeem its subordinated notes, which is coming up in November. They do have a the agencies, the rating agencies like Standard & Poor's, they do allow or take into consideration 50% of these towards their equity, and upon the maturity or the call date, that will disappear. So Woolworths is looking to underwrite some of that with their dividend reinvestment plans. I guess part of that is looking at whether there's a replacement security. At this stage, there's been no comment that I'm aware of. Whether they'll come to market, but they are going through a restructure with masters. So ultimately, it'll depend on the capital requirements that they believe they need going forward on that. I think one of the things, we've gone through the first couple of comments there about some of those other securities came up. One of the things that, that I think will continue to support our market is that there is, well, for want of a better word, a wall of cash coming. We've got Origin, which is probably about the 900 million, Woolworths, which is probably about 700 million, and the various ANZs around $1 billion. Potentially got close to 2.5 billion coming up in maturity. All of that is going to be looking for a home. So and that'll depend on what gets rolled and what doesn't. So I think in general sense, taking aside potential macro political issues that may impact it, it should be reasonably well supported. We expect that that to be reasonably positive for the sector and with that cash. So and so we'll look at the margins. The maturing ones margins. Some of those will be upscaled to a higher rate if they come through, and the ANZ will probably be closer to the recent ANZ, which we think is actually an attractive return. Some of our recommendations at the moment, ANZPA, well, that's now rolled to the ANZPG, so it's still like the ANZPG. The ANZs, which is coming up, the IAGs, the NABs and the Westpacs. I guess, some of those there, we think there's some opportunity, just on some of these that are actually maturing, for short-dated security, all relative to your ability to enter the stock. But on an annualised basis, even if some of these are shorter dated and if you can acquire some of these cost effectively, coming back up to the taking into consideration moving back to the face above $100 and picking up a coupon, relative to on an annualised return, considering that back towards what term deposits are, there are some opportunities there. And we think that not just on that as a return in its own right, but there are potential strategies for people to take up some of these in the market now with the view that they might roll into a new issue, and that allows them to roll into a new issue with nil cost associated to that. And not only that, but actually give them access in a market where some of these raisings we've seen, particularly with the financials and the banks, we've seen them upscale their initial offering, and we've seen people get reduced on their allocations. This potentially, the rolling of those gives a potential entry point. So if you'd like to discuss those opportunities, feel free to contact Kenneth and myself. In the bonds, the government bonds, look, I suppose the problem is the yield, and it's not the problem, it's just the expectations relevant to the risk that the yields are quite low on these. So again, for retail investors, it still might be more appropriate to look at term deposits with the government guarantee, depending on your level of investment, particularly for retail investors. But there's in a diversified portfolio, we're still looking at these for risk mitigation. And even though the yields are low, particularly the short dated, not the long dated, because there's capital risk with the long dated if yields go out and prices come back. But they're probably obviously more favoured in in periods of severe equity uncertainty or volatility. XTBs, an exchange-traded corporate bond, it gives opportunities for picking up not just government bonds but corporate offerings, and so there are, again, particular opportunities in that space when looking at diversification. If you're looking at corporate bonds, this is one of the slides I did 6 months ago. I think the main thing there is to, the way that you approach it is to, you obviously understand it, accept that the lower yields offer the benefit of lower risk, particularly when we're looking at holding bonds for diversification. Look at different industries, but understand the complexity of that. And the Australian ratings, provides issuer credit ratings and their complexity indicators. So take those into consideration when you're, putting a portfolio together or considering that. Morgans do have some great research that can assist in that, help and understand, and one of the things that, that I think is important is obviously having the ability to make an informed decision, understanding your risk, and making decisions on information that is relevant to you. I think when we're looking at how we do take considerations, we don't look at it just the cash yield. We're looking at yield to maturity, and particularly in the durations, looking at those shorter dated ones in that bond market pricing, for the concerns of risk. So in summary, consider that long-term approach. Albeit obviously there are opportunities, and particularly in the shorter dated securities, we think there's opportunities in those from a yield perspective with greater certainty, and also from our ability to roll into potentially longer dated ones at higher margins. Obviously diversification, not just capital structure, but also the timeline in which you're they mature or the call date. Still think term deposits, they're probably, in that space, offer the best risk-adjusted return, in the current environment. And there's a few key picks there, but there's some of the ones that, the ANZ, IANGs, the NABs, and the Westpacs, we mentioned before. But there's also some in that space of the bonds. We like the Caltex, which is a CTXHA, PEEP, which is PPCHA, and the Suncorp ones there. So that's sort of a bit of a summary as to where we think. The main themes from that there are ultra low cash rate environment, expected to be prolonged, potential a couple of cuts coming over the next 12 months. And there's a few issues coming up there in call dates, and some of those will roll to new securities. So there are opportunities there, and feel free to contact us on that space there if you'd like us to help apply that to your personal circumstances. So now, probably the more exciting stuff. I'll pass it over to Kenneth.
Cheers. I thought I'd just quickly do a bit of an update, and so since we last spoke, the market's actually improved quite substantially. It's added over 300 points, and what's actually really pleasing is the fact that since February's low, which was a pretty bad stretch for the market, we've actually put on over 10%, and we're creating a nice uptrend in the market. So by that, I mean that we're slowly creating higher highs in the market and higher lows. So it's actually a pretty good technical sign for our market. Look, global events in the last month or two have seen volatility come back, but not in the same vein as what was happening back in that January-February period. We don't expect this low volatility period to continue. We actually think that that it'll revert back to more historical levels, and I suppose I'll touch on this a little bit further on down the track. But earnings through reporting season were all right, but we did see some encouraging signs, particularly in that mid-cap space, and I suppose we think that this might be a bit of a build of momentum, particularly in our market. So I thought I'd do a comparison, as Mark did, and what we presented in the last 6 months as opposed to now. So back then we saw a reporting season that was stronger than anticipated, but again it didn't shoot the lights out. Again, back then we were not in I suppose the cheap zone for the market, but we were trading much more in line with the historical PEs, and the commodities and energy market had just taken an absolute battering, and we thought that that might have been a bottom in commodities and energy prices. So what's flown through to today? Reporting season, again, it was all right. Profits were up, but I suppose we did see a little bit of erosion through analyst expectations going into reporting season. It's definitely a macro sort of events that are driving our market at the moment. It's not a domestic event driven market. And we've actually seen a fair bit of sector rotation, which is pleasing to see. So by that I mean that money that wasn't going into commodities and energies and the banks back in Feb has started to trickle through. It's just buying up I suppose the cheap level of of those particular sectors, and the PE levels are actually trading quite high. But with the low interest rate environment that we're in, it is supporting these multiples. So on to reporting season. Look, it met expectations. And as I just said, we did see erosions going into reporting season on consensus numbers. So basically that means that expectations were met, but definitely weren't exceeded. Large caps were the unfortunate letdown. We only had 11% of the large caps beating expectations, and so if you compare that back to February, it was around 25% back then. Look, our analyst team thinks that this reflects the deflationary economic forces and sector-specific issues, particularly in the energies and commodities space, and I suppose the large consumer staples. But on the positive side, there was fewer missed expectations. So again, just reiterating why we think that is, the earnings expectations were eroded coming in. Companies are now giving flatter guidance, so they're not starting at a high end on a company level. But I suppose what we saw last year was at the same time the expectations by analysts was about 11% profit growth. Now we've actually seen that come down this year to 3%. Now that we're, I suppose, looking at analysts' forward guidance again, they're expecting 16% for next year, and we think that there's a pretty good chance that these might be eroded away as we've seen throughout this year. Look, finally, a pretty amazing phenomenon happened. So total dividends paid to the market declined 9%. Now, that's obviously due to the large caps in the energies and commodities cutting their divs, but we actually saw 65% of companies on the ASX increase their dividends. So unfortunately, it just wasn't enough to offset those majors. I did touch on the domestic economy a little bit, but I thought I'd quickly do a run through. It's a bit of a two-speed economy at the moment. We've got a clear downtrend in unemployment, which is always pleasing to see, and we've had slightly above trend growth for the 2016 financial year. What we need is to keep this trend going, and we believe that accommodative fiscal and monetary stimulus should be, used to support this. On the downside, however, we do have low wage growth and persistently low inflation, and our chief economist believes that that's going to keep the door open for rate cuts. Look, this is always a positive story for the market. Cheaper money always should naturally flow through, and on top of that, we're actually one of the only developed markets that's growing above trend. So look, we think that that might attract some more foreign investment. On the US, and Mark touched on this before, the unemployment rate there has been in a very strong downtrend over the last, say, 5 or 6 years. We think that it's now getting towards that full employment level, and this should tick over into inflation. It is starting to happen. We did have a slightly better read over in the States for their inflation numbers, but as that wage pressure starts to build, it should flow through. The US economy, we've got for the next financial year growing above trend. Now, look, we believe that at least one rate rise will happen in December, and I suppose what we've seen is the Fed has signalled rate rises are looking further away. Our in-house view is that that won't be the case, that we will see, I suppose, a bit quicker tightening than what we've witnessed. So if you look back last year, the Fed had four rate hikes penciled in for this year. That obviously didn't eventuate, and they've said that they're data dependent, but our chief economist thinks that the inflation will now start to tick up because of the strong employment numbers that have been flowing through, and he's seeing 2 to 3 rate rises. So look, we're actually quite bullish on US stocks in general. We believe that their earnings have bottomed. Look, valuations at the moment are a little stretched. In the short term, you might see some weakness, but we think this is more of a good buying opportunity rather than a steep sell-off, and I suppose particularly so with a falling Aussie dollar if rate rises do occur. I'll just touch on the global economic picture, and it's much the same as what I put through in March. Japan and Europe are still struggling with growth and inflation, and they've continued their push into negative rates. The Bank of Japan's continued to buy ETFs, bonds, basically anything it can get its hands on. We are living in abnormal times in that situation. It is truly incredible to see how many bond yields are in negative territory. Look, and on what Mark touched on is the fact that we think that there's going to be lower rates for longer. There's slated to be $2 trillion worth of debt next year for issue. However, there's already mandated purchase over that amount by central banks. So we just can't see them raising anytime soon. Look, the central banks are trying. They're waging war against deflation and stagnant growth, and our chief economist believes that the latest round by both of these banks will have, start to have its desired effect. On the other side, China's continued its stimulus program. Look, and it is pleasing to see that worries about its growth have since abated. The capital outflows that we spoke about, which were causing concern early in the year, have also stabilised. Look, we maintain that China's continuing through a transitional phase to a more services-related economy, and we think this will greatly enhance our position to export higher quality goods and services rather than just bulk commodities. We think it's a terrific opportunity to capitalise on a rising China middle class. On the commodities front, the seasonal bounce that we spoke about in April has since abated. It definitely did pop up from the low 30s when we were speaking to over 50, which is great to see. Again, seasonality in this period of the year is usually weak, and we have seen that start to come through. Look, we actually think that while the shale oil producers over in the US have been quite resilient with the oil price above 50, we actually think a key catalyst for this is when they have to start refinancing their debt. Look, our analyst believes that they're going to, a lot of these companies are going to struggle to do that, and look, we're already seeing a bit of a rebalance underway, but we expect the oil price to slowly tick up through the rest of this year and into next year. Iron ore and coal have been fantastic performers. They've definitely been helped by the Chinese stimulus that's been pumped in, but always good to see. We have seen, like I said, a little bit of sector rotation into this area, and I suppose while we are thankful that this has happened, we do caution pure plays. So we much prefer to stick to the diversified earners in this space. On the currency front, the AUD has actually been range trading really for most of the year. It's ducked its head under 70 cents for a little bit, and at the moment it's at around 76.5. We think that the top is going to be around that 78 cents. I think bias in at least in the short term is to the upside. What we've been noticing is that the yield premium when our dollar's stable is quite attractive for overseas investors, and they're using it as a bit of a carry trade, particularly on the commodities exposure that we've seen increase. So look, while we do think that in the short term that's there is a little upside in the Aussie, look, our medium term to longer term view is that will trend down, and this is based on the fact that we think US rate rises become more certain around December, and people will start repositioning into those US dollar exposures. I mean, on that front, we're pretty happy to buy domestic companies with offshore US dollar earnings, and I'll just flick on to the next page, which will just go through this a little bit more. Look, there's some pretty quality companies out there that do have that US dollar exposure or exposure to a rising US economy. CSL, RWC, Reliance Worldwide, which is a recent listing, and IPH, they're all US dollar earners. As I previously spoke about, the sector rotation back into commodities, our key picks, BHP and Oil Search in that space. Also, the yield premium that we're seeing on our market is pretty substantial when you compare it to term deposits, and we are seeing a flow through of monies, and I suppose our picks, Westpac and CBA and the banks, and then on the infrastructure and utilities side, we still like Sydney Airports and Transurban, just on the fact that we think rates are going to stay down for longer, and they've got some fantastic assets in there. So on a more diversified front, we still like the healthcare space. Obviously Ramsay's was one of our picks back then, but it's run pretty hard. Still like it as a long-term play. CSL, and we've got some an international ETF there. And then I suppose two little themes that we're running with is domestic tourism still. We like ardent leisure, we see further upside there, and Sydney Airports again. And then on the technology side, we think actually it's quite hard to get that large cap exposure on our market. So we prefer names like Apple, Visa, and there's a Nasdaq ETF there. On the smaller smaller cap ASX listed stocks. There are a couple that we have been buying. We're recent buyers of Megaport, which is a new listing under Bevan Slattery, and then we've got Speedcast and Superloop. So, look, I think it's just important to diversify your portfolio, and these are just some of the names that we've run with. Finally, we run a few model portfolios out at our office, and these are them. We've got an income, a balance, and a growth. And you can see the sector, the client returns against the index returns. Look, they're obviously split for different purposes, but it's pleasing to see that they've all been travelling well on a long-term basis. So.
All right, thanks, Kenneth. Yeah, look, I mean, the model portfolios, we use them particularly from a perspective of risk management. We have there's a 13-person investment committee that incorporates the institutional desk, the retail desk, and the research team. And for those that don't have the time or don't want the involvement in their customised portfolios, then there's some great opportunities in those model portfolios for that's the Australian share component, but there's also fixed interest, property, in cross-asset portfolio positions. So that's all for today. Thank you for taking the time to dial in. Just one final bit of housekeeping is that the Mount Gravatt office is soon to be relocated. Matter of fact, this Friday, so as of Monday, the what's that, the 3rd or 4th? 3rd of October, we'll be located in Turbot Street, Santos House. So the naming of the Mount Gravatt office will be renamed to Morgan's North Quay. Our contact details, email, phone and fax will all remain the same. So we look forward to chatting to you in the future. All right. Thank you, and enjoy the rest of your day.